Hey there, everyone. Happy Monday. After a choppy trading session, the S&P 500 essentially finishes unchanged. 10-year yields pushing higher, though, with the 10-year hitting 4.7%. Bank sectors holding ground despite market weakness. Charts like Alphabet still are holding their uptrend. We'll open up the final bar mailbag. Does technical analysis make sense at all for value investors? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the Final Bar. Happy Monday. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. The technical toolkit is really designed to focus on the markets themselves. We can talk a lot about what companies should do given the overall conditions about their industry and about their company-specific issues. We can talk about the macroeconomic conditions and the Fed and rising rates and high inflation and what all of that might mean. At the end of the day, it's all about what happens to prices. That's what you invest in. That's what you are tracking. That's how you are measured. That's how you can track your performance. It's about looking at price. So why not analyze it on its own? And that's what technical analysis is designed to do. When you look at the markets today, a choppy, noisy session. Actually, the last hour saw a nice move to the upside to push the major averages essentially unchanged for the day, although the NASDAQ was up about 0.2%. You know, defensive sectors really getting crushed here recently over the last week or two. Sort of counterintuitive as you feel the market getting a little uncomfortable, sort of talking about downside movements, but then defense, like utilities, not doing particularly well. And we open up the final bar mailbag. We have some really good, thoughtful questions from many of you about how to deal with defense and potential underperformance, how to think about technical analysis for value investing. And I would argue very relevant. You just have to use the toolkit a little bit differently. Got a lot to cover here today as we look at how the charts evolve. Let's get to our market recap. We're going to start with a poll. And we asked you recently, great question over the weekend, how do you prefer to watch the final bar with David Keller? Hopefully I do is the overarching answer here. So for the 15% that said, what's the final bar? Shame on you. You should know better. Now, 14% of you said you like to watch the show live. 70% of you say you watch the replay when you get time. Good thing is we're happy with all of the above, except the people that don't know what the final bar is. Hopefully, if you're watching this, that it's no longer the answer to your question. If you like to watch it live, we certainly are preferring that as well, and we're happy to have you here live as we shoot the show. We do have the chat open today for the first time. We're going to start using some of the interactive capabilities built into YouTube as time goes on. You are welcome to use the chat. We won't be able to look at the chat here live in the near term, but certainly we'll be there moderating the room. Keep it civil, help each other out, support each other, ask questions. Any questions that come up during the show, pop them in that chat because we'll be sweeping that chat during the end of the show every day. Make sure we fill the mailbag with any good questions that come in. So another way to get your questions to us. We may have some more interactive capabilities as we go on, but that's how we're going to use it for now. If you can't watch the show live, that's okay as well. We will continue to provide it as a replay as soon as we can going forward. Let's get to the market recap today and talk about what we saw. Now, a choppy session is how I would describe this, I think, better than anything. The S&P is still closing below 4,300. There's a nice rally going into the close, but that was just enough to get the S&P basically flat for the day. Now, the NASDAQ was up pretty much for the entire day and certainly doing better than the S&P and well above the Dow through the course of the trading day. The NASDAQ composite finished above 13,300. So you have this interesting conundrum, I would argue, of higher rates and all the signals today of rates remaining elevated, but growth stocks that should not do particularly well in rising rates are the ones that did the best today. So go figure that one. We'll look at the charts together and see what conclusions we can draw. Mid caps and small caps, by the way, both down a pretty decent amount today. The S&P 600 small cap and the S&P 400 mid cap indexes both down about 1.3 to 1.4% today. The NASDAQ 100 representing that mega cap leadership, the FANG stocks, or the Magnificent Seven as we are calling them now, up 0.8%, leading the way higher out of this group of indexes. Volatility actually increasing, but just slightly, right? VIX is about where it was on Friday's close, kind of in the 17.5-ish sort of range. And again, the general back of the envelope thought with the VIX is below 20 is a low volatility environment, above 20 is a high volatility environment. And in an environment like this, I think you generally want to think about the conditions and have a view of where you think things are at, and then have some signals, some indicators, some reference point that should tell you to revisit that thesis. And an example of that, when we get to semiconductors, we'll talk about what could be a bull flag pattern, what we would need to see to confirm that, and what would tell us maybe that that condition is incorrect, that read is incorrect. With volatility, I would say the VIX spiking above 20 would be one of those big time red flags for me, because the VIX remaining below 20 during a choppy period is usually just a choppy short-term corrective pattern, but long-term conditions are still okay. When the market really gets bearish, when things really go risk off, volatility tends to spike because there's a fear that is palpable in the markets. And the measure of the VIX still below 18 tells you we're not seeing that sort of traditional bearish level of fear. I would be, if I were you, set an alert for when the VIX breaks above 20. That is certainly something I'm looking for. And if and when, and probably more when than if that would happen, that tells you things are starting to get a little more uncomfortable. Interest rates continue to push higher. We had some comments from Fed governors through the course of the day today. Powell as part of a conversation, all sort of implying this kind of hawkish tone of, rates needing to remain elevated for as long as it takes to get inflation to come down. And unfortunately, that prospect of higher rates usually is not a great thing for the types of stocks that have been so dominant in recent years, mega cap growth stocks, or certainly growth stocks in general. You're seeing the mega caps do the best, and maybe there's an indication in there where that's kind of the defense of the day, right? But we'll get to that as we open the mailbag. For what it's worth, 10-year yield touched 4.7%, came off a little bit, finished today around 4.68. The long bond yield around 4.8%, 5-year yield above 4.7%. So you've seen sort of the medium to long-term end of the yield curve continue to drift higher. This is as short-term rates are still pretty elevated, well above 5%. So we still have that inverted yield curve, but you're seeing the long end start to go higher and higher. And basically why that is happening, or how that is happening, is the bond markets are in an established downtrend. Look at a chart of the TLT or the AG, and I will tell you very clearly they are going down. They are very much not going up, and that is what is part of rates going higher. The TLT, by the way, was down 1.7% today. Make a note, so we'll look at that chart here in a minute. Dollar index up actually a little bit. The UUP is touching 30, the $30 amount. I'm not less concerned about that big round number for the UUP. I don't think of it in a similar way that I would to stocks or ETFs, where I think people focus on the dollar amount a lot. The UUP is really more of a way to play the dollar index, and so up 0.8% tells you we're continuing to see a strong dollar environment. A lot of red on the page of commodities here. Gold down another 1%. Silver absolutely crushed today. The SLV was down 4.5%. Crude oil, copper prices all moving to the downside. You can see the commodity-oriented sectors all struggled today, and this is a bit of a change from what we've seen. We've been talking about this overall, resumption of a commodity bull market phase. A number of my guests have talked about that recently. You're not seeing it on a day like today. You're seeing gold continue to be bright red on the daily return list. Cryptocurrencies, a super choppy, noisy session, and you can see the gap higher, the move higher from around 27,000, getting near and near to 29,000 for Bitcoin. It settled down, currently trading right just below 28,000. We're currently down about 1/3%. This is after a noisy period here the last 24 hours of an upward swing and now a pullback. Ether price is just below 1670, and that's down almost 4% from yesterday as well. Finishing off here, looking at the 11 S&P sectors, it's the FANG sectors at the top. Technology, communication services, consumer discretionary. Those are your only 3 sectors finishing in the green. Tech was up the most, up 1.1%. Communication services up 0.8%. Everything else was in the red. Utilities, the biggest loser today, down almost 5%. Charts like NEE got absolutely decimated, down over 10% today. And we'll get to that when we get to our mailbag segment, because we had a great question about defensive sectors, how they've been performing here recently. If you look year to date, it's not been great for defensives, and we saw a bit of a stretch there, sort of first couple weeks of September, where utilities was actually starting to outperform. We've given all that back and more now at this point. Energy second from the bottom, down almost 2%, and real estate down 1.8%. Let us get to the daily chart of the S&P 500, just sort of take a stock on what happened here today. So, what we mentioned, if I remember right, on Thursday's show, was just how we've basically been in a range. And I remember writing to my premium members at Market Misbehavior over the weekend. We were talking about, just look at the range that we've been in on the S&P. After this sell-off, which was almost a week ago, I think it was last Tuesday session, I want to say, maybe last Wednesday session, You have this drop close below trendline support, but then from there, every trading day has been overlapping, right? So we're no longer in this like clear direction where we keep making a lower low or keep making a lower high. We're in obvious upswing or downswing on this tactical time frame. We're sort of chopping around here. So I see this when you take a step back and look at what happened. We broke down through the neckline of this head and shoulders pattern. We've tested this trend line using the major lows over the last 12 months. And now we've stalled out here, right? After that breakdown, you really haven't had that follow through. We've sort of been treading water. After that first break, we haven't closed below that close yet. So overall, it's sort of like the move lower, and now we're holding water. We're really sort of treading water here. Unclear which way we move from here. And again, I think one of two things happens here very quickly. If you think about just the range we're in, the 200-day moving average is around 4,200. One of the longer-term measures we've talked about is as long as we hold the 200-day, things are just not getting that bad. We start breaking the 200-day, the S&P goes below 4,200. I think you need to think about the possibility and certainly the probabilities of further declines, right? How deep of a move that you might expect, what that might mean for risk assets you might hold in a portfolio, how you're managing downside risk, how you're making sure that you preserve capital if there is more of a prolonged decline. But again, until we break the 200-day moving average, things just haven't gotten that bad yet. Now, the other scenario here is, let's say we don't break the 4,200 level. Let's say we, tread water around here a little bit longer and then break back higher. We get back above 4,350. All of a sudden, this looks like a failed head and shoulders top. This looks like a breakdown that did not follow through. And all of a sudden, we're in a bit of a recovery. And all of a sudden, you have to look back to some of these previous swing highs, see if we can regain those levels. So, the market certainly has stalled out. While it's not going up by any stretch, looking at the major averages, it doesn't seem to be going down anymore over the last week or so. So I think looking to see if we break below 4,200, that for me still remains a key level to pay attention to. The head and shoulders topping pattern, by the way, that we've talked about measures to 4070, 4080, we'll call it. And that's just basically taking the height of that head and shoulders pattern, projecting that from the low. And in technical analysis vernacular, you call that the minimum downside objective. The idea is once you've had a topping pattern that is confirmed, which we have, it says the minimum downside objective is around 47. It doesn't mean we can't go much further than that. It just means the height of the pattern implies a move at least to those levels, which suggests another 4 to 5% below current levels at least before this corrective move is over. Now, what's interesting is we are now in a pretty pivotal month. September tends to be pretty weak, certainly played out very well. With that as a backdrop. October is when many major market lows have occurred. November and December actually tend to be quite strong. And so, setting up for a potential bottom here makes a ton of sense based on the traditional seasonal patterns, particularly in a pre-election year. So an important chart, as always, to watch. But, certainly as we've stalled out a bit, to see if that downtrend would continue lower. Again, 4,200 key level that I'm certainly watching. I mentioned bond prices. This is the chart of the TLT. If you look at ag and other bond ETFs, you can see they're all kind of breaking down here. Gap lower in mid-September, continuing to push to the downside. This is basically the 10-year yield flipped upside down because this is bond prices, which move inversely to bond yield. So rates are going higher because the bond market is selling off, and it's selling off a lot more quickly than stocks are, which is why the stock to bond ratio is still kind of in this glorious uptrend that has been lasting for many, many years. No change in that yet, as bond prices just accelerating to the downside. And rising rates have a number of implications. Again, in our mailbag, we'll get to a couple pieces of that for sure. I wanted to just highlight in our Mindful Investor live chart list a couple things. We didn't have a live show on Friday. We did an all mailbag episode, and if you missed it, it was really, really good. We had 10 fantastic questions that we handpicked from some of the great questions we received last week and in our live Q&A last Wednesday. Make sure you check that one out here on our YouTube channel if you missed it. But on Friday at the close, my medium-term model actually went negative. It went bearish for the first time since March. The last two times that medium-term model has turned negative, it was in December of last year and March of this year. Both of those, of course, the most recent sort of tactical drops, corrective sort of pullbacks before we made a new swing high. So we're right in that similar pattern. Now, in both of those cases, we only went slightly below zero and only for a week or two before we went more positive. This is already looking a lot different than those, and it looks more like a deeper corrective pattern like we saw in 2022, perhaps in 2020, or even back in 2018. So again, not saying the S&P is going to go to zero or anything, but the movements that I'm seeing, the weakening breadth characteristics, my market trend model turning bearish on the short-term and medium-term timeframes has not happened too often, certainly in 2023, suggesting a renewed, sort of emphasis on the deterioration that we've seen so far from the S&P and the major averages. In terms of breadth, a couple quick charts maybe to show you. In terms of stocks above their 50-day moving average, we're almost down to single digits. We're down to 12% as of today's close. So that line just keeps going downward. So what's interesting is late July, 90%, 9 out of 10 S&P stocks above their 50-day moving average. That's as we're teasing 4,600, talking about the potential to retest all-time highs at 4,800. From there, 90% now below their 50-day moving average, or almost there, which means most of the S&P basically was above the 50-day and now is broken down through that key short-term measure of trend. Now, the S&P obviously well below its own 50-day moving average around 4450. One way to think about it is do we start to see a turn higher in this breadth indicator? And when we do, which will happen at some point, that may be one of those early warning signs that the deterioration we've seen is now starting to be alleviated, because you're starting to see some stocks not just bounce off of a new low, but actually recover their 50-day moving average, which means they've regained a lot of that lost ground. That is why one of these indicators, or these indicators in particular, can be super helpful for just defining the downtrend and then getting some early warnings that that downtrend may be exhausted. For now, this is certainly more of a market in deterioration as I would describe it. Now, when you talk about the Magnificent Seven stocks, it's interesting to see that charts like Alphabet just keep working. Alphabet up another 2.5% today, broke below the 50-day moving average about a week ago. You can see similar pullbacks below the 50-day in June and July, really, from earlier this year. Similar pattern here. We went below the 50-day, spent a couple days below, and now back above it. So charts like this keep making higher highs and higher lows. On that pullback, by the way, even with a gap, we did not undercut the August low. So while a lot of individual stocks have broken key support, Alphabet for now still holding in there. And again, the relative performance, the momentum still pretty strong. So I have no problem continuing to own charts that are continuing to be fairly strong. Now, with that in mind, think about something like semiconductors. I'm inclined to label this a bull flag pattern. What a bull flag pattern basically is you have this big run higher, which you'd call the flagpole. You have this parallel decline, and you can even copy the line down like that. And the trick, by the way, is hit the Command key on a Mac keyboard. I think it's the Alt key on a PC, but I don't use PCs too much anymore. And if you hit that button, tap with your mouse, you can make a duplicate, a parallel line. That's a great way to draw channels on the stock charts platform. Look how beautifully that lines up, declining highs, declining lows. Now, this pattern is confirmed when we break above the upper trend line. And that's why I would say that this sort of choppy period that we've been in, there's further downside to be had. There's certainly some short-term upside, some tactical upswings you can see. But until you break above a trend line from the previous highs, it says that that trend is still down until proven otherwise. So I'm looking at this as a short-term downtrend. A break above 155 for the SMH would alleviate that downtrend condition, would confirm a bull flag pattern, which would measure a lot higher. So as I'm thinking of September into October, seasonal weakness turning into seasonal strength, charts like SMH breaking out of those patterns could signal an exit of this pullback phase and maybe the beginning of something more constructive. We're going to open the Final Bar mailbag here in a few moments. Before we do so, a couple quick announcements. First off, these questions that I'm about to read all came from people like you in the last couple days. We've got some great questions over the weekend. Our mailbag is always open, and email is the best way to get them to us. thefinalbar@stockcharts.com. We're on X @FinalBarSCTV. On our YouTube channel, you have a couple choices now. Drop a comment below any of the videos you're watching on our Stock Charts TV channel. During our live broadcast, just put a comment right into the chat. We'll gather those questions and hope to answer one of your questions in our next mailbag at the end of this week. Also, as a reminder, we have a live Q&A coming up this Wednesday, 10 a.m. Eastern. So we look forward to interacting with many of you there. That is a full Q&A with the chat open. We'll set up in our podcast studio around 1 p.m. Eastern. I'll have a chart or two just to kick things off, and then we'll start at the top of the chat and just go through the questions. The conversations in recent weeks have gone anywhere and everywhere, and I'm super open to that. Anything we can do to help you make sense of these markets, particularly using the technical analysis toolkit, we are certainly happy to do it. So go to the live tab on our YouTube channel if you want to see the upcoming live events, and make sure you set a notification so you won't miss when we go live this Wednesday, 1 p.m. Eastern. Let's open up the Final Bar mailbag, and here is question number 1. Dave, why are consumer staples, utilities, and other defensive stocks doing so poorly in 2023? So fantastic that you asked this question. This came in, I think, at the end of last week. And it's so fascinating because today, what an exclamation point, what a perfect day to have this discussion. Just look at the sector summary today. And again, the sector summary is has a place of honor on my dashboard. If you're a Stock Charts member, which you obviously all should be, if you go to your dashboard, we're giving you more and more flexibility here. You have some limited flexibility for now. You click the little gear icon and you can add some different panels, move some things around, and you click on the little more lines up here if you want to change it to any of the other pre-built features. Coming later this year, hopefully very soon, we're actually going to open up this page with an initiative we call panels. You basically be able to have all sorts of different panels, eventually custom built panels to bring whatever market data you want right to the forefront and more make Stock Charts your own platform. For now, I think the sector summary is a really good place to start. And if you look at what happened today, right, bonds sold off pretty good. Rates were higher, right? The 10-year yield hit 4.7% for the first time in many moons. During that period, you have growth stocks actually doing remarkably well, which is unusual given the fact that rates are going up so aggressively here and the prospect of rates remaining elevated. Technology, communication services, consumer discretionary, all doing fine with that as a backdrop. But look at what's actually doing quite poorly. Some of the defensive sectors, particularly utilities and real estate, have gotten crushed here recently. I would argue what happened in the first half of 2023 without the AI frenzy that kind of came out of nowhere, right? At the beginning of the year, I don't remember talking about AI as a major market bullet point through 2023 as you're looking for the next 12 months. That's not something that kind of naturally came up as a leading theme, but first into the second quarter, it became a huge deal, and all the AI or anything related to anything AI all of a sudden started to rally to the upside. Now, this is in the face of rising rates, which is what's so unusual about it, which in general is not particularly great for technology companies. So two sort of disagreeing things were happening at the same time, which happens a lot more in finance than we probably want to believe it does. I would argue that this corrective move that we've been experiencing has been in some ways the market sort of waking up to the reality, the prospect of higher rates and rates remaining elevated for an extended period of time. Comments we heard from Fed governors today sort of echo that idea that rates are going to remain elevated. Years ago, when I was looking at offense versus defense and just thinking about, people go into utilities and real estate when they're looking for an additional income to sort of balance out their portfolio, particularly during periods where the market is uncertain. That makes sense when rates are, in single digits or down at the, 1% range, right? When you're getting nothing for a savings account or very little, then you're not getting much for your cash. You want to put it in things that are getting cash, something like a utility stock or a REIT or a consumer staples name, right? A defensive sort of blue chip type of name paying a healthy dividend, more mature company. The problem is now that rates are so high, now that you can get the interest rate that you can for bonds, for a savings account, for a money market account, you really don't need to deploy your cash into income generating equities. You can actually do better in the bond markets. That's one of those things that happens in this particular type of environment where you have inflation so high, you have rates spiking higher in relation to that or in concert with that. So I would argue that you're seeing defensive sectors probably do a lot less good than they would otherwise. I wouldn't be surprised in another era if defensive sectors were doing much better because you would have seen investors rotate from offense to defense and get into some of those income-oriented stocks. You're not seeing that. And there's no great value proposition for a utility company when you can do better, when you can get a better yield elsewhere. And so I think that is certainly a big part of why defensive sectors are doing so poorly. I would continue to think, though, and another way to think about this, by the way, is if you go to charts and tools, we have this page called the sector performance chart. And it's really good. I've showed this on the show many times because if you go to the bottom, there's Sam Stovall's idealized model of sector rotation. If you're not familiar with this, I would spend some time looking at that chart. It's an idealized chart, so the market does not always follow that perfectly, but it's often a really helpful way of making sense of what we're seeing and hearing. This performance chart is looking at the 11 S&P sectors along with the S&P itself. And you can normalize the chart. So we're doing this to look at the relative performance of all of these sectors relative to the S&P 500 as our benchmark. You right-click on the little time frame and say year to date. you can see that the three FANG sectors are positive, have outperformed. Technology outperforming by 21%, communication services by 26%. Utilities have underperformed the S&P by 31% over that same period. So this is another way to kind of show that relative weakness. Now, again, I've been doing this for about 23 years or so, and others that I've learned these techniques from, we're doing it much, much further than that. There has always been something else going on, and it has always made sense, I think, to look at offense versus defense in some way. Consumer discretionary versus consumer staples, I still think is a meaningful benchmark. I like using the equal weighted versions of those, which is what we mentioned on the show before. Overall, still favoring offense over defense for now. Question number 2. You recently said volume doesn't mean what it used to mean. Could you please clarify? Absolutely. So when I'm talking about volume, and what you have to remember, on most of my charts, I don't actually show volume at all. And this is where I think that question came from. And I mentioned last week, I forget what this was an answer to. I mentioned volume indicators. So a lot of our users actually show volume on their charts. I don't have a problem with that. And on stock charts, one of the great ways to do it is this. On sharp charts, just say volume overlay. That just kind of puts it underneath, kind of behind the right above the x-axis, basically for the price. And then if you say color volume, it just color codes them. So on my chart, red are down days, are down closes. Black bars or black, the histogram is basically an up close. So you can visually very quickly see spikes in volume where those on up days or down days. So when I was learning technical analysis originally, early 2000s, I was first introduced to it, and volume was a big part of what I was taught. And if you look back at Edwards and McGee, where they're talking about some of those key price patterns like head and shoulders patterns and others, triangle patterns, John Murphy as well reinforced that volume is an important part of that pattern. Edwards and McGee, if I remember right, I might be misquoting this, so I apologize, Edwards and McGee, in memoriam if I'm misquoting your book, but I seem to remember that they would even say that if volume didn't match their sort of ideal pattern, it wasn't a valid head and shoulders top, right? It was sort of a lighter volume through the course of the pattern, a big spike in volume on the break of the neckline, or in a breakout of the base, you would want lighter volume and then a big spike in volume. Now, the reason back in the 1960s, 1970s, when a lot of those books were written, why they focused on volume, you have to remember a number of different things, right? Stocks only traded on an eighth usually, right? So which means 12.5 cents between each tick. I mean, that was the tiniest amount possible. Now we can go sub pennies, right? And so volume actually meant a particular thing because stocks were traded at a post in a physical exchange. Buyers and sellers would come together. You could see the print, the volume, and you could understand tick data and the order of trades and start to draw some conclusions. All of that has been flipped on its head, if not more by now, right? You have dark pools, off-exchange trading. You have a lot of algorithmic trading, automated trading, high-frequency trading, hedge funds, just hedging positions that reflects volume. You have, trades happening in a lot of different locations, all electronically, and then all being compiled into a composite tape. So it's just the structure of the market has changed so much. So I don't think you can draw the same conclusions we did that you could 50 years ago. When you see the stock move and there's a certain volume component, I don't think you can interpret it the same way. Now, is there still value in looking at volume? Certainly, perhaps, and I know some analysts that have done very well incorporating volume as part of their practice. But for me, I know from time at Fidelity, did a lot of studies on volume. We found it didn't add a lot as much as just analyzing price. Analyzing price itself had great value. We were able to perform quite well using it, so we focused on things that would help us make money and help our shareholders make money as well. Now, having said all of that, if I was going to use volume, which I do occasionally, and you'll see it pop up if you're looking, I tend to use volume-derived indicators. Joe Granville's On Balance Volume is probably an easy next step if you're interested in volume because it uses the daily volume reading. It aggregates it a little differently. Other indicators like Mark Chaikin's Money Flow, I think, are vast improvements to those methods as well. Next question, how do you play NVIDIA here? So full disclosure, no recommendation. As always, all of the standard disclaimers hopefully still apply here. So having said that, how could one interpret the movements in NVIDIA? I'll restate your question. So, what's interesting is as I've mentioned before, I think of stocks at any given point as being in one of three phases. It's going up, it's going down, it's going sideways. Dave Landry believes that so deeply he has it tattooed on his arm. Ask him at a conference, he will show you the tattoo. I've seen it, it's true. But I think of it as three phases. Accumulation, meaning the phase is higher. Distribution, the phase is going lower. Consolidation, the phase is sideways. And at any point, you can probably determine, and usually determine very easily, which phase we're in. I would argue the chart of NVIDIA is in that third phase, that consolidation phase. And the reason why I would describe that is we were in a clear uptrend phase of higher highs and higher lows above two upward sloping moving averages. That's now changed. We're now making, we did make a slight higher high at the end of August, but the lows are kind of even. Instead of being above an upward sloping 50-day moving average, we're actually on top of a flat 50-day moving average. So overall, I would say this uptrend phase for now has hit a pause button in August and September. The question is which way we break from here. On a chart like NVIDIA, I would be super happy waiting for a break below 400 and or a break above 500. And I would bet that whichever way we break out of this range, that would be the direction of momentum. And that's a technique that comes from a number of different analysts. I think of it as a John Bollinger thing where you're in a trend, the bands are widening because volatility is increasing. All of a sudden you settle into a range, volatility comes in, and that's waiting for a break to the upside or downside. I would say with NVIDIA, you're kind of in that wait and see mode. The SMH chart we looked at earlier, kind of a similar idea. That's actually more of a downtrend phase, but I think same thing. It's sort of a wait and see mode to see if that trend continues and if we break down or we're able to break out of that bull flag pattern. So I think semiconductors in general kind of wait and see mode, and I think it's time to be patient and see which way we break out to the upside or the downside. Next question, has the yield curve ever uninverted due to long end rates rising and not due to the Fed cutting short-term rates in response to an economic crisis? That could be a whole course at business school, I feel like, in Fed history. So I will give you like the 1 to 2 minute version that is not as exhaustive as what I could probably give you there. The best way to think about the relationship between the yield curve and stocks on stock charts is you go to the Charts and Tools tab at the top. On the right side, go down to the dynamic yield curve. This is a simple but wonderfully powerful visualization just showing you the yield curve on the left and the S&P 500 on the right. And it only goes back to sort of the late 90s. So unfortunately, we don't have a ton of history to work with. And that's the first sort of general way I would answer your question. When you talk about has this ever happened with the Fed and rates, you have to remember that sort of the modern era of the Fed and what it's doing with raising rates and lowering rates as a way of fighting inflation. Again, I'm not a perfect Fed historian, but from my experience, from my understanding, that's a Volcker thing that happened in the 1970s. Before then, and really in the 1970s, anywhere back there, the Fed had a very different mandate and saw their mandates very differently. This sort of idea of where we're at now, where the market goes higher, the yield curve is steeper, all of a sudden things starts to get uncomfortable, the yield curve inverts, we have a recessionary period, and then eventually the yield curve rights itself and conditions improve. That is more of a modern era in the last 30, 40 years that it's really settled into that. And it started with ultra high rates in the 1980s that helped bring inflation back into check. And the solution there was just keep rates really high for really long. And that is where I think a lot of the more recent Fed chairs, which have mostly been historians of the Fed, to be honest, have sort of followed that general approach to things. So, has it ever happened? In my understanding, no, I don't think so. My understanding of the modern era is we exit this by the Fed lowering rates, which sort of creates this normal yield curve. And you can see that if you go back, just the more recent examples, like the financial crisis, we had the inverted yield curve. This is in 2006 to 2007. You go forward a little bit, you can see the long end of the curve was kind of staying where it was there for quite some time. And the short end of the curve is just kind of coming down. You can see the same thing back in 2000, the inverted yield curve. Again, you can see the short end coming down, and that's what causes things to change. So once things really start to slow down, once the economy enters a recessionary period, stocks are really starting to struggle. That's when the Fed is able to sort of change and go back to more of an optimal shape to the yield curve. So that is my 2-minute answer to what you said. Everything I just said could be a full lecture. Maybe I'll work that up into a conference presentation at some point. But short answer is no. In my understanding, I don't think that's ever happened. If I'm wrong on that, if you know the answer, drop a comment, let me know with a link to some article or something. I'd love to learn more about that. Final question, how do you use technical analysis for the value investor, or is technical analysis just incompatible? So no, I would say the type of technical analysis that we talk about on the show, usually related to growth-oriented investing, or what we call momentum investing. This is the idea that you're looking for stocks breaking out, you're looking for stocks improving in price and relative strength, you are looking to play in on that continued strength. And that is a methodology called momentum investing or trend following, which is what I definitely subscribe to, or generally subscribe to. Now, having said that, is there an opportunity to use technical analysis more for mean reversion, which is buying weakness? Absolutely. You just have to use the toolkit a little different ways. I've often mentioned with indicators like RSI, and that's where I would point you to as a starting point. There are different ways to use an indicator like RSI. And RSI, I think, as a measure of price momentum, can be a fantastic leading indicator. If you look at what's happening here in July, August, September, now into early October, we can see that the RSI recently became oversold. And this is Pfizer we're looking at just as a recent example. This is a stock in a clear downtrend. What you often will look for with a stock in a downtrend is some sort of bullish divergence. In a normal downtrend, when the stock goes to a new low, you'll see the stock become oversold because there's an acceleration in selling pressure. There's a lack of buying power as a result. The stock makes a new low, and because there is such a downward push to the price, we become oversold. Then we rally, the RSI rarely gets above 60. At the end of a bearish phase, you'll often have what's called a bullish divergence, where the price actually goes down, but the RSI goes lower, which is why in a chart like Pfizer, it's important to look for bullish divergences, right? Which would be a price making a new low, but the momentum not getting it to a new low. So we became oversold on that recent drop. We're having a bit of a bounce here. Do we make a new low in price and the RSI does not get below 30? That's what I would be looking for on this chart as an indication of a potential reversal. Other indicators that you can look at would be something like PPO, MACD. Often you can look at these on a weekly basis. If you want a more longer term read, here we're looking at on the daily chart. You can see just as of today, we're getting a buy signal from the MACD indicator. Again, this is a short term signal, but basically telling you, similar to these other signals back here, that the trend has exhausted and we're now starting to see a reversal to the upside. So there are indicators that are more mean reversion indicators. RSI, the divergence, more of a leading indicator to anticipate a turn. Something like MACD, more validating that a bottom has most likely occurred. I would look at indicators like that on daily, maybe even weekly timeframes, depending on your investment horizon. You may find some opportunities there for sure. Folks, we've got to wrap the show. Great questions, and thanks so much for populating our mailbag with some really thoughtful questions. But we got to wrap it up and go to the 3 in 3. 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. The market recap goes by so quickly in the show. I had so many charts I was thinking of showing you. One of them that we didn't have a chance to visit was the bullish percent index. So I'm happy to highlight it here as one of our 3 in 3 for the end of the trading day here on Monday, October 2nd. If you look at the bullish percent index, a lot of breadth indicators have been more bearish, right? In a bearish range, sort of validating the fact that we're in a corrective phase. I think that is now a foregone conclusion. I think that's pretty clear. The question now is, how deep and how significant is this drawdown? Indicators like the bullish percent index have often been really helpful when we go below this 30% level. And I've highlighted in green over the last year and a half the times when we've gone below that 30% level. Look for when we go below that level and then back above. The most recent time that happened was when it was in March, which was the last real significant drawdown that we saw up until the last couple months here. So when things now start to go lower, when you sort of think, all right, now I think the trend is down, which I think it is, the question now is, what signs can we collect, what signs can we observe that indicate that this pullback phase is now nearing its end? The bullish percent index going below 30% could be one of those signs. It's getting very close. Today actually dropped a little bit further. Chart number 2, NextEra Energy. I mentioned utilities and a great mailbag question, really thoughtful about why some of the defensive sectors are not doing well. And I would argue it's mostly about interest rates. Interest rates are so high now that defensive sectors just aren't as attractive as they were before. So we may have to think about different ways of measuring that rotation away from offense. I think a move to more cyclical offense like energy and materials could be a part of that, sort of allocating away from equities and into commodities as a different asset class. But let's be clear, the utilities charts are going down quite a bit. NextEra was down about 9% today. Look at this acceleration to the downside over the last week or so. But the real point real reason why I wanted to show this chart was not to highlight the fact that it's gone down a lot, which it has, but look at all the other signs before the last week that told you the chart was down. And this is why when people ask me why I don't buy new lows, it's because things like this happen. If you buy in, early August because it's making a new low and you think, all right, this has gone down enough, NAE is probably a really good long idea. That on its own, never make it went down a lot as your main investment thesis. That often does not play out well because prices go down for a reason. What you're seeing is this last rotation lower is just the latest in a step of in a downtrend phase that's been going on for quite some time. This support level around 70, by the way, was a huge support level that was broken in early August. We retested that from below here in early September, which was also the 50-day moving average, and we keep on going down. Finally, United Healthcare, UNH, making a nice upswing today, up 2%. I'd like to see it complete that rotation above the July and August highs. Almost did it today here. We did close just above those levels. I'd like to see follow through the remainder of this week, but we now have a higher low, a bit of a higher high. So while charts like the semiconductor group are going lower, look at areas of the market like healthcare that actually had been in a downtrend, now starting to pound out quite a decent recovery. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the Final Bar. All of our previous interviews, some really good conversations, are here on our YouTube channel, so make sure you check them out. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night. Telly Award.